From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Tuesday, March 22nd. Here are the top market stories we're following for you at this hour. Faster is better. St. Louis Fed President James Bullard saying the Fed needs to be more aggressive in repeating his call for rates above 3%. And the bond sell-off deepens. Treasury yields climbing across the curve as the market digests calls for multiple 50 basis point hikes. And little progress. The Kremlin says Ukraine is dragging its feet in peace talks, while Ukraine says Russia is negotiating in bad faith. We'll speak with a key advisor to President Zelensky. From New York, I'm Kriti Gupta with Guy Johnson in London. Alix Steel is off. Welcome to Bloomberg Markets. Guy, it's fascinating when we talk about simply what is actually happening in the markets. What are they actually trying to price in right now? It seems like the spotlight is on the Fed.
Oh, the spotlight is firmly on the Fed. Clearly, we're watching what is happening in Ukraine because that's going to be a complicating factor in terms of what happens economically here. But the focus from the market's point of view is definitely what is happening here. And I have to say, 50's got to be the base case now, hasn't it, Kriti? Are you still as bullish with Fed speaker after Fed speaker after Fed speaker after Fed speaker, basically going 50, 50, 50, 50. 50 looks like the base case. Could be 50 in May, could be 50 after that. Could be a series of 50 basis point hikes. Does that affect the bullish case?
I think the assumption here is that just because the Fed hikes, you're going to see this kind of massive crash in the market, which to some extent is true when you kind of take the punch bowl away. But if you actually were to chart it and look back in history, I did this morning. I wish I had it for you. But basically, if you chart the S&P 500 and the Fed funds effective rate, the more it rises, stocks rise with it. So I'm curious if that historical trend is kind of being thrown out the window right now, given the geopolitical tensions. But to your point, I'm still bullish.
You've got to bring evidence. If you're going to bring it with evidence. Okay, let's talk about the data next time. Let's talk about the data. Richmond Fed Manufacturing Index actually comes through at 13. The prior number was 1, the survey 2. So that's some pretty compelling evidence that the manufacturing sector is healing and healing pretty fast and is on a tear right now. So that's got to be maybe further evidence to the idea that we are going to see 50 basis points coming through. I'm basically trying to position Kriti here as the antithesis of Lisa. Lisa, very bearish, Kriti, very bullish. We can have a nice little debate going there. Anyway, as you say, Kriti, the St. Louis Fed President, James Bullard, on Bloomberg TV a little bit earlier on. This is basically where our question of the day comes from, talking about the fact the U.S. monetary policy needs to tighten quickly to stem inflation.
What you have to do is move the policy rate up discreetly, a fair amount, not to be too disruptive, but I think 50 basis point moves would definitely be in the mix, and then get to a level that we can be neutral, and then from there we can decide if we want to be restrictive and put further downward pressure on inflation. But right now we're putting upward pressure on inflation. It's the wrong place to be given where inflation is.
So that's our question of the day. Is faster better? A faster hike's better from a U.S. economic point of view to get inflation under control, to put the U.S. economy on a sustainable footing. Let's kick this around. Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence, joining us now. Wow, have we seen a big move at the front end of the U.S. curve. We've got inversions. Do they matter? And joining me here in London, Bloomberg Markets editor for EMEA, Christine Aquino, fresh back from holiday. Got lots of thoughts on what is happening here. Christine, let's bring it to you first of all. Bullard thinks faster is better. What do you think?
Well, Guy, if there's anything that markets will be worried about, it's going to be pace. And so if you put forward to the markets that, hey, faster rate hikes, multiple 50 basis point rate hikes over the next couple of months is probably the way that the Fed is going to go, that will probably spark a little bit of worries among investors. Because, I think markets this year have really gotten their heads around the possibility at one point of a 50 basis point rate hike. I mean, this was all the discussion that we were having in early February before the war in Ukraine broke out. And of course, that changes some of the equation, but 50 was very much a possibility for the markets at some point. But now that we know what we know when it comes to the impact of the war in Ukraine in terms of commodity prices, the inflationary impulses coming from that, but also the potential hit to growth coming from that, the picture's a little bit more complicated. And so if you give markets kind of this hurried pace in policy, that's definitely bound to raise some eyebrows and cause a little bit of worry here.
Well, let's bring in Ira Jersey into this conversation. Ira, talk to us about the rates picture, because yesterday I think was pretty notable for kind of the wonkiness that was going on in the bond market. Can the markets, bond market, stock market, even the commodity market, really digest the idea of faster hikes?
Well, we already are digesting the idea of faster hikes. Now, whether or not that's going to actually help the economy or not is a different story. I think that it's going to be impossible at this point for the Federal Reserve to hike anywhere near what they're talking about and not slow the economy into a recession. Now, it doesn't necessarily have to be a deep, really bad recession. It could look a lot more like the 1992 to 94 period, which really was a relatively shallow recession. But the Fed almost has to put us into a recession at this point in order to fight inflation, because they have to bring demand down, and in order to bring demand down, by definition, you have to slow the economy. The market's already pricing, in fact, for a recession next year. When you look at the shape of the yield curve, so Guy mentioned kind of the shape of the yield curve. You just mentioned the wonkiness in the yield curve a little bit over the last couple of days. And we're priced for a recession for 2023. So, in order to avoid that, the only way the Fed can do it is to go slower. One last thing I want to mention about James Bullard. Remember, in 2008, he wanted to hike interest rates because oil prices were high. That would have been exactly the wrong thing to do in 2008, in the middle of the financial crisis. Right. So keep in mind that historical context of his own statements and in terms of how hawkish he is.
Ira, the market's got the peak in yields June 23. It's got cuts priced for June 24. Do you think that is about right? Do you think that's off? And if so, by how much?
Well, I do. Obviously, the market is pricing that, which is one of the reasons why I noted that that in order for the Fed to avoid that needing to cut in early 2024, that they're going to have to go slower than the market's currently pricing. Now, will they go slower? Will they hike a 50 in May? Yeah, maybe they'll hike 50 in May. But I think the idea that, like, I know one of the street banks came out today thinking they were going to hike 50 in May and June and then go another 100 basis points in the second half of the year. That is going to create a lot of market turmoil. That will certainly invert the yield curve a lot more, and I think push us into a deep recession. So I do think that the Fed's going to go slower than that. The question is how much slower, and I do think that they're still going to hike. The question is, that pace that was just talked about a moment ago, I think has to be somewhat slower than people are thinking right now.
Christine, hop on in here and hopefully balance this a little bit, because it seems like a lot of doom and gloom. But as you kind of heard Guy mention at the top of the hour, I kind of am taking a little bit of a bullish stance. Is a recession guaranteed if you have these commodity shocks, if you have this aggressive rate hike? Is there no other option to kind of avoid it, just given the strength of the consumer that especially you're seeing here in the United States?
Well, Critty, yeah, I think that's a very good point to make, that, a recession, even though that was potentially something that we saw in previous hiking cycles and in the aftermath of them, this is a very, very different sort of economy that we're looking at, particularly in the U.S. As you rightly pointed out, of course, demand is still very, very strong. The labor market, obviously, very buoyant as well. And I think that's partly why, prior to the breakout of the war in Ukraine, it really was investors were definitely buying into the idea of a potential 50 basis point rate hike from the Fed, because it really looked like the economy was firing on all cylinders. And now, I think what the war does is to maybe slow down that process a little bit. But I think now that we've heard from Powell and really gotten an insight into how the Fed is thinking about the inflation growth balance, we know that they are very much focused on inflation. And that really is just driving home the point again to markets that this will be the priority for the Fed in terms of its policy response this year.
Ira, equity markets are rallying. Do you think the Fed's going to be comfortable with that? Do you think that's basically signaling that the markets are not in the right place yet from a Fed perspective? How are they going to be reading what risk takers are doing right now?
Well, so the one good thing about inflation, which we haven't had for the last 3 or 4 economic cycles, is that you can keep profitability reasonably high, right? So equity markets and risk asset markets don't have to do particularly poorly, even if we have a significant slowdown in the economy. And look, I think we're looking at the wrong thing right now when we're assessing the overall growth of the economy. We're looking at nominal sales and nominal consumption. You can't look at that anymore with inflation at 7%. Look at unit sales. They're already falling. That's a sign that we're likely to see a significantly slowing economy going forward, even if prices keep on running at 3 or 4%, which is also what the market's pricing for, Guy, which is the reason why I think a lot of people are concerned that the Fed's going to go too far and become much more restrictive maybe than they need to. It's because, high commodity prices are going to keep headline inflation much higher than a lot of people really want.
Well, thank you, Bloomberg's Christine Aquino and Ira Jersey of Bloomberg Intelligence. As always, we appreciate your insight. Well, we're going to get a better take on that. We're going to speak to Jeff Lacker, a former Fed official, coming up on simply how to adapt to a hawkish Fed. Coming up next, though, we'll talk with the chief strategist at Principal Global Investors, Seema Shah. She's coming up next. This is Bloomberg. St. Louis Fed President Jim Bullard says the Fed needs to be more aggressive in tightening monetary policy and repeated his call for rates to be above 3% this year. So our question of the day asks just that. Is faster better? Are faster hikes better? Let's ask Seema Shah, chief strategist at Principal Global Investors. Seema, thank you so much for being with us here. Give us your take here. Are faster hikes better? Do you agree with James Bullard?
Hi. Well, look, I mean, faster hikes, it's clearly going to help inflation come down. And perhaps if you have faster hikes, then it means that they don't need to hike as much. So I guess that's a positive. But overall, I think what Bullard was suggesting is a clear negative ultimately for the US economy. If you're still going to have the same terminal rate, but a faster pace of this, then I think the risk of recession certainly increases pretty drastically.
Seema, what's your base case right now? Because certainly the Fed speakers I've been listening to over the last 24 hours sound very hawkish, and 50 increasingly looks like it's the base case right now for markets.
Yeah, so I think what we're expecting is it seems likely that there will be a 50 basis point hike at some point this year, especially with inflation at this level and still rising. Now, beyond there, I would think that we would expect the Fed to hike aggressively in the first part, so really front load those hikes, and then maybe give themselves a bit of a breather towards the end of the year. Now, remember, if you get to where the Fed dot plot was, if you get to rates at 1.9% by the end of this year, that's just taking you to just above where rates were pre-pandemic. And if you remember, pre-pandemic, there weren't really any concerns about US recession. We had a pretty strong economy, very robust. So I do think that the US economy can handle rates of that level. It's when you get into the restrictive territory, when you get to that 2.8% level that was in the dot plot for end of 2023, then I think you have to start thinking about economic slowdown and even recession.
Seema, I'm curious about one piece of what you just mentioned, essentially that it gives them a little bit of room to breathe by the end of the year. That's my question to you. We have all these kind of recession odds being priced into the market, but if the Fed does have a little bit more room to perhaps cut rates in the future, which of course the market is pricing, is a recession still guaranteed for the United States?
Well, I think for the Fed, the intention would be to raise rates and then hold them there. They want to have that cushion to be able to cut in times of real stress. So, they only cut if the recession comes. And I think that's key. So what we would anticipate is if the Fed can get it right, they raise rates this year, they give themselves a bit of room to go quite gradually next year, and then they have this glide path. Now, unfortunately, as we know from history, it's quite rare for the Fed to ever be able to bring inflation down from these kind of heights without precipitating a slowdown or even a recession. So I think the odds are certainly not in their favor in this.
Okay, so a soft landing looks like a tough ask right now. Let's talk a little bit about what that means for asset allocation. Bonds don't look like a great investment, according to most people right now. Credit looks a little bit shaky. Equities, though, everybody seems quite bulled up on equities, Seema. Are you in that camp as well?
We're somewhere in that camp. I think we are positive for equities for this year. Right, we still think that the US economy is pretty good fundamentally. We look at the strong balance sheets. We look at the household sector, which is extremely strong to this point. And we feel quite positive about equities. Are we going to see very, very strong returns this year? I don't think so. I think we're going to see single-digit returns, so significantly lower than 2021. But as I said before, I think the concern really goes when you think about 2023. And then at that point, then I think certainly parts of equities will be challenged. And this is really the time when picking out your sectors, picking out specific companies becomes key. It's not enough once the Fed is no longer keeping rates very, very low. Not everything is going to keep rising. So investors need to become increasingly selective as this year goes in, and as this year goes on, and certainly into 2023.
Seema, I'm very glad you mentioned that you were bullish. As guys point out multiple times, I am as well. But I'm curious, though, about the other side of the equation. When we're talking about higher inflation, we're talking about higher commodity costs. But to what extent has the market actually digested the impact of that, especially to the end consumer? Things like planting season in Ukraine, for example, that still remains an unknown. The market's still very wavering on that when it comes to food prices. How much of that can you tangibly say the stock market or even the underlying economy is actually prepared for?
I think that's a great question. When we think about what we've seen for the geopolitical crisis so far, is that it's going in waves, right? We start off talking about oil prices, then we started thinking about, oh, well, look, what about the overall commodity space? Then you get into food prices, and then you think about fertilizer. And ultimately, what you're doing is you're increasing that bandwidth of that impact of this geopolitical crisis across sectors and across regions. So as of today, some parts of emerging markets, some of those some of those commodity exporters look like they could do pretty well from the rise in prices. But actually, when you dig deep and you start thinking about fertilizer, then I think there could be some concerns growing.
So that's interesting because certainly the trend of late over the last few years has been that geopolitical shocks have an ever sort of decreasing half-life, i.e. the market moves on from them increasingly quickly. Do you think that's going to be the case this time round? Do you think the sticker shock of this conflict is already past, or do you think actually there is more still to come that the market isn't even aware of yet?
So I think you're right. So in previous crises, what we said, we as have done a fair amount of analysis looking into previous crises, what happened. And typically, on average, you saw the S&P 500 fall 7%. It took 3 weeks to get to the trough, another 3 weeks to get back to the pre-crisis level. And typically, 12 months out, markets are up. But the times when that didn't happen, where the market really struggled for a prolonged period, was when the macro backdrop was impacted by the geopolitical crisis. Now, in this situation, of course, we have commodity prices, which is really key. But also, Russia as an economy is very much ingrained in the global economy, something very different to what you saw with Syria, with Iraq, with a number of different places. So the sanctions are also going to have a reverberation across the global economy. So I think it's not, we're probably going to have a more prolonged impact of this geopolitical crisis beyond just this month. Of course, who knows how this goes on? I certainly can't predict. I don't think anyone else can. But I think we do need to be more, we need to recognize more that the impact could be beyond just what's obvious.
Seema, I'm curious about simply capital flows here in times of crisis. As you mentioned, wherever in the world you may be, there is a historical tendency to quickly go to American assets, whether that's bonds, whether that's the dollar, whether that's the U.S. equity market, tech, of course, being the heavyweights there. Could you foresee a situation where you do start to see, even in the face of decelerating growth, some of those flows come back to the United States and push the similar gains that you saw in the last couple of years, perhaps not double digit, but similar gains in terms of that's what's driving some of the equity action?
I think that the US will probably be the outperformer in this. Everyone relatively weak, but the US outperforming. And it's exactly what you said. Not only is the US a safe haven, but in this specific crisis, the US is less exposed. It's a commodity exporter, it's more energy efficient in terms of consumption, and it doesn't have the trade linkages like you would for Europe. So I think there is a case to be made that the US, through all of this, is probably going to come out a little bit stronger relative to other regions. And certainly that should help drive performance in the US.
Seema, great stuff as ever. Always appreciate your time. Thank you very much for today. Seema Shah of Principal Global Investors. Thank you very much. Maybe that's the reason why Curry's a little bit more bullish. She's over there and I'm over here. Okay, coming up, the nickel market begins to stabilize after that unprecedented squeeze that sent prices spiking. We're going to hear from the CEO of the LME next. This is Bloomberg. So things are finally getting back to normal for nickel traders on the London Metal Exchange. Prices trading within the LME's daily limits, which of course have been expanded for the first time since reopening last week. Earlier, we heard from the LME's Chief Executive Officer, Matthew Chamberlain.
The fact that we've gone limit down for the last 4 days does suggest that that clearly the price had been inflated by that short squeeze, and it is now logical, with the situations around that squeeze having been resolved, that we would come down to a more normalized level, and obviously the Shanghai price is a good guide there. Today we'll be trading down into the with the limit ability to go down into the 26,000. And I think there is a good chance that we'll discover a price over the next couple of days, possibly even today.
Good morning, Matthew. So you've now had a couple of weeks to consider what's been a pretty hectic situation. What do you think you went wrong? And I know there are many counterparties involved, but I specifically want to pin you down to what do you think the LME did wrong or could have done better?
Yeah, so I think we've clearly been dealing with the immediate challenge, and there's going to be a lot of time for us to reflect on the lessons learned. But I think that there's a few points that I would make. The first is how this squeeze, how this position was allowed to arise, and I certainly think that we need to look more closely again at oversight of the OTC markets, because clearly this is an issue that came from the OTC markets and then impacted the exchange. Then, as has been well publicized, we have had challenges in delivering our price limit. So in order to bring the market back to normality, we needed to make technical changes to our systems to allow to limit the price going down on each day. And that's not something that the LME has ever done before. And we worked very quickly to bring in that price limit technology. And we clearly ran at that hard so that we could get the market reopened. There have been some well publicized glitches, which I don't think have made a difference to the fact that we just went limit down each day, but clearly have been embarrassing for the LME.
Yeah.
And again, that's what happens when you have to deliver these things at speed to reopen the market.
That was Matthew Chamberlain, the LME CEO, speaking with Bloomberg's Anna Edwards and Mark Cudmore. Guy, what's fascinating to me about this story is it's bringing kind of flashbacks back from really 2020 when you started to see the markets crash so violently. And every time futures opened, you would see these kind of limit up, limit downs. Yep. It never occurred to me that this would happen with nickel.
So there's a bunch of things happening here, one of which I think he talked about the OTC nature of this, which I think is interesting. A lot of markets are being forced into using clearinghouses. I wonder whether that's next. The other thing is, with this kind of volatility, the big trading houses are really struggling. I'm wondering whether their calls for more liquidity from central banks or others will be heeded. We certainly see that in past crises. Commodities front and center. St. Louis Fed President James Bullard speaking earlier. We're going to hear from former Fed Chair Jeff Lacker. This is Bloomberg.
We're an hour into the U.S. trading session. A little bit of green on the screen. Bloomberg's Abigail Doolittle is tracking the moves. Abby, what do you see?
Well, Kriti, here's your bullish view here. You are right on stocks being higher. The S&P 500 up 0.9%. The tech-heavy NASDAQ up even more, up 1.5%. This after yesterday falling modestly. But remember, it follows the best week since November of 2020. So overall, right now, we have this upward, this risk-on whipsaw for stocks. And you can really see it also with the Russell 2000 and the banks up 2%. Now let's take a look at what's driving the banks. And it's impressive that the tech-heavy NASDAQ is up so much, because take a look at this two-year yield, really incredible. Over the last 2 days, up 23 basis points. That's really just amazing. Although, if you recall, a few weeks ago, it was up 25 basis points in a day alone. So this huge backup in yields yesterday, of course, on the much more hawkish talk out of Fed Chair Jay Powell. In fact, it has the two-year note on pace for its worst quarter going back to 1984. If we take a look at this in the Bloomberg terminal, we will see on the quarter so far, this is just amazing. The two-year yield basically up 1.5%. If you recall, it wasn't so long ago we were talking about, will the two-year yield be, or excuse me, the 10-year yield, will it be at 1.5%? Well, here's the two-year yield again, matching the worst quarter, almost on pace for the worst quarter, going back to 1984. And Guy, that of course was when Volcker was the Fed chair. You can see that ripple effect of his hawkish stance back then, very firm stance, showing in this chart right here strongly.
Well, Abigail Doolittle, excuse me, thank you so much for tracking those moves. Let's talk more about the Fed here. St. Louis Fed President James Bullard saying that when it comes to raising interest rates to fight inflation, faster is better. Bullard speaks to Bloomberg International Economics and Policy correspondent Michael McKee.
Faster is better, and I think the 1994 tightening cycle or removal of accommodation cycle is probably the best analogy here. That one was quite successful. The Fed moved 300 basis points in a single year and then made some adjustments afterwards in 1995. The result was that we hit our 2% inflation target over the next 10 years. The economy boomed in the second half of the 1990s. So I think this is a situation that's like that. We came out of the pandemic, it got surprised by inflation, but now what you have to do is move the policy rate up discreetly, a fair amount, not to be too disruptive, but I think 50 basis point moves would definitely be in the mix, and then get to a level that we can be neutral, and then from there we can decide if we want to be restrictive and put further downward pressure on inflation. But right now we're putting upward pressure on inflation. It's the wrong place to be given where inflation is.
Well, as I noted, the markets, whether you look at swaps or futures, are now pricing in 50 for May 4th. The Fed doesn't like to surprise the markets. Should we assume that that's what you're going to do?
Well, I can't. I'm just one person on the committee. I don't know where the rest of the committee will be, and the chair has to manage that process. I thought that was a good speech yesterday that laid out the situation, and we'll see where we are when we get to May 4th.
Now, the economic data have been closely watched, but from what you're saying, it doesn't sound like it really matters between now and May, that we're too low in terms of the Fed funds rate and inflation is too high, and those are the only two considerations.
Well, that's the big picture, and I think that's right, that we don't really need a lot of more data here, but you never know in this world and in this business. You can always get surprised. Obviously, we've got geopolitical risk out there. I guess my feeling on that is that, we can't wait for that to get resolved. This could go on for a very long time, and certainly geopolitical tensions, even if the war ended tomorrow, the tensions would last for a long time. So I think the best contribution we can make is to get our house in order and make sure that the U.S. economy is doing as well as we can achieve, and that will be the best that we can do to contribute to the global situation.
St. Louis Fed President Jim Bullard in an exclusive interview with Bloomberg Television a little earlier on, speaking to Mike McKee. Let's get some reaction. Former Richmond Fed President Jeff Lacker joins us now. He's now an economics professor at Virginia Commonwealth University School of Business. I promoted you earlier to former Fed chair, so I apologize for that, Jeff. Let's talk a little bit about the current market pricing. 50 in May, 50 the meeting after that. Do you think that's about right?
If I was at the Fed, I'd be advocating for a series of moves like that. The story of the day here is that the Fed's trying to recover its credibility, which was badly damaged last year by their misdiagnosis of inflation and then the protracted delay while they cleared out their tapering process. I think that they made a big step in the right direction with last week's meeting and the messaging around that. It wasn't credible. Their economic projections don't hold together. They're not really believable, but they're a move in the right direction to indicate a series of rate hikes this coming year. I think Chairman Powell yesterday, you saw him in that speech, was a recalibration, a tightening of the hawkishness. I think he realized that the messaging around the meeting last week was not coming across well. I expect more of that in the future, but messaging alone isn't going to do this. The Fed spent the entire decade of the 70s proclaiming loudly that it wanted inflation to be lower, but it took actions in the early 1980s rather than speech to actually bring inflation down. And I think the same thing's going to be true this time around.
Jeff, I'm so glad you mentioned the 70s and the 80s, because I think there's a saying out there that history doesn't repeat, but it does often rhyme. I'm curious what the precedent here is for a move like this. I mean, obviously, we've never really dealt with a pandemic at this scale before, but should we be looking to the 80s in terms of demand destruction, or 1994 in terms of hikes that are bigger than 25 basis points? What's your take in terms of where in history we might see a little bit of a roadmap?
I think Jim citing 1994 is apt. Now, the Fed at that time period didn't do much at all to telegraph moves. We're in a different environment now where the game is to telegraph ahead of the meeting. But still, I mean, it's an indication that the economy could and financial markets could pretty well withstand 50 basis point, 75 basis point moves if needed. I think that precedent is there. I think that the aberration was 2004 when Greenspan bent over backwards to telegraph the pace of the move and when the moves would begin. Yeah. And so, yeah, I think 50 is not untoward.
Jeff, sorry, just to back up a little bit there. Are you putting 75 basis point hikes on the table here at a single meeting?
Not now, but, if they move with alacrity, they should be able to do it, but it could happen. I mean, what I expect to play out is that inflation is not going to come down in the middle of the year all by itself, as the Fed has laid out, as Chairman Powell described last week. I think that it's going to persist. There are a lot of forces pointing in that direction towards more inflation momentum going forward. Wages have accelerated, firms are passing on costs, and so on. But in addition, so inflation is not going to come down the way they think. They're going to be forced to raise rates faster, and that's going to call into question their labor market forecast. I don't think 3.5% unemployment at the end of this year and next year is at all plausible if they're going to raise rates enough to make progress on inflation. What we'll see over the end of this year, towards the end of this year, is an answer to this question. If they're faced with the choice, and I think they're going to be faced with the choice, which do they choose? Do they choose to fight inflation first and let labor markets heal after that? Or do they soften their stance on inflation when unemployment starts rising? I think that's the $64,000 question we're facing.
Jeff, I'm curious about the commodity side of the equation. I mean, we know that those oil prices have really been the key driver when we're talking about these inflation costs, but there's a lot of commodity shocks that perhaps have yet to come, that have yet to be digested by the economy and by the market. Food prices are, for one example, that I'm especially watching. How much does that factor into the Fed's decision to perhaps curtail even more of that demand?
So when commodity prices roll in, if they're transitory, they'll roll out again. What they do to inflation on an ongoing basis depends entirely on how the Fed handles it. When commodity prices are high and other prices haven't risen yet, what you'd like is for people to wait, to postpone spending until commodity prices are low. And the way to do that, at least in the Fed's toolbox, is to raise real interest rates, which increases the reward for waiting. So it's not obvious that commodity price shocks should lead to easier policy. At times, they should lead to tougher policy.
Is a soft landing at this point possible, do you think, Jeff?
No. We're either going to get they're either going to get inflation down, or unemployment's going to stay low. But they can't do both. I just think that opportunity has passed them by. I think they missed the chance for that.
Jeff, how much room do they have for a U-turn here? How much breathing room have they really perhaps given themselves or will give themselves by the end of the year? I know rate cuts are priced in for 2023, potentially 2024. How much breathing room is there really?
So they're claiming mid-year inflation is going to sag. So June, July, August, those meetings, I think, are going to be telling if inflation's not falling, if it's not softening, as the staff's undoubtedly projecting for them. Then they're going to be faced with the choice whether to tighten, increase the pace of tightening, or sit tight for a while. And so they basically have until then. I mean, they'll throw in a 50 in the next two meetings, maybe two, and see where we get. But I think they have until mid-year to really demonstrate that their hope for inflation coming down on its own, with their modest pace of tightening built in, is actually viable.
What about the balance sheet, Jeff? What should they be doing there? Should that just be on rails in terms of the runoff, or do they have to be more dynamic with it?
I don't think they want to be dynamic, and I don't think they need to be, and I don't think they will. I think they'll put it on a faster track, but I think they'll do it in the same sort of formulation where there will be a cap on the amount by which their holdings fall any given month. If they're wise, they'll roll off the housing stuff, the mortgage-backed securities, more rapidly and get out of that faster than treasuries. But I think he signaled pretty clearly that they want to do it faster. I wouldn't be surprised at all. I'd be surprised if they don't announce a roll-off at the next meeting.
Jeff, you're an economist by trade, but I'm curious about your market take here. I think you kind of have to keep an eye on the bond market at these times. What is your take on what the bond market is pricing here? I think we're looking at 7 rate hikes throughout this year. Mm-hmm. Is that a plausible bet to be making?
Sure. I mean, I think it's going to take more than that to really get inflation under control. I think they're taking Chair Powell at his word that the committee is committed to reducing inflation and views that as a prerequisite for employment growth. So they view him as making the choice in the direction of bringing inflation down. I think that they're at first last week, I think the markets maybe took the Fed's projections too seriously. I don't think they were skeptical enough about them. Now they're a little skeptical about how much rate hikes are going to be required. And I think that solution to the puzzle of last week's projections, I think, is the right one, that what they've sketched out requires faster rate hikes than they put forward. So I think the bond market reaction seems well warranted.
Well, Jeff Lacker, former Richmond Fed president and economics professor at the Virginia Commonwealth University, thank you so much for your expertise and your time, as always. Coming up, what will it take for Ukraine's President Zelensky and Russia to reach a peace agreement? We'll talk with one of Zelensky's advisors, Cambridge economics professor Alexander Rodniansky. This is Bloomberg.
This is Bloomberg Markets. I'm Rishika Gupta. You're looking at a live shot of the principal room. Coming up, David Salby, the anchor and managing director and portfolio manager. That's on Bloomberg Markets. The close. This is Bloomberg.
So the Ukrainian President Volodymyr Zelensky has called on Pope Francis to mediate in the war with Russia. In a tweet, Zelensky said he told the Pope about the difficult humanitarian situation that the country is facing. Meanwhile, the Kremlin once again said the peace talks are going more slowly than it would like. Let's talk more about those talks. One of President Zelensky's key advisors is Alexander Rodniansky. He joins us now. He is an associate professor as well of economics at Cambridge University. Alexander Rodniansky, thank you very much indeed for your time. The President Zelensky is talking about maybe some need for some divine intervention in terms of these talks. Let's talk a little bit about where we are. You have a useful insight into the progress that is being made. What can you tell us about how far the talks have gone in terms of securing some sort of a lasting peace, and how much further there is still to go?
Well, first of all, thanks for having me. So we're in the talks already. We have to give them a chance, of course. I'm a little pessimistic as far as their prospects are concerned, but there are certain issues on which we can reach an agreement relatively easy. Those issues concern the neutrality status, for example, as long as we have tangible security guarantees that are given to us, unlike in the Budapest Memorandum. So we're willing to talk about that. There are other issues that are basically non-existent but important for the Russians, something like the Russian language, let's say. So we never had any issues with that, so that's relatively easy. But there are, of course, certain points which are completely off the table. Anything that concerns our sovereignty or territorial integrity, that's never going to be discussed. Now, as far as divine intervention, as you say, that's good. We have to give peace a chance.
Alexander, this is Creedy in New York. Thank you again for joining us. I'm curious about a potential meeting between Zelensky and between Putin. Is that something that is potentially on the table, and do you think that could help perhaps speed up some of the progress in the talks?
Well, certainly we have to do anything that we can to speed up the talks or have any success. We have to give any type of negotiation a chance. Unfortunately, the Russian side hasn't been willing to talk to us directly. The Russian leader hasn't been willing to talk to our president directly for a long time. So we don't see any change in that in that sense, but we have to give it a try.
Alexander, do you think that the Russians are negotiating in good faith? There is an argument that says that they are talking because it provides cover to further their objective on the ground. What do you think to that argument? What do you think about the idea that the Russians are not negotiating in good faith?
Yeah, so this is my fear. I've been saying this for some time. This is, in fact, quite a realistic possibility because we see that what is happening on the ground is not really consistent with what they've been saying in these peace talks. You don't look for peace and intensify bombardments of our cities. These two things don't go together. So there is a serious concern that they're using these peace negotiations as a trick to deceive the West into thinking that peace is around the corner and therefore further sanctions aren't necessary, right? So this could be a sort of strategic ambiguity on their part to signal to the West that, look, we're actually, trying hard here, but in fact, they're just preparing their new offensive. And this is all a deceptive move.
So what can be done to perhaps counteract that? Is that something you're waiting for in terms of sanctions? Is there more that can be done there or more from European governments? What would help, like I said, more progress?
Yeah, so I think this regime has proven over the years that it respects only strength. It only understands the language of strength. It has been deceiving consistently throughout these years. We heard that there was no troops on Crimea. Next day, there were troops on Crimea. In the build-up to this war, we heard this was only a military exercise, and then we saw what happened. So we can't really trust them. What we can do is put pressure on the Russian regime economically. That means increasing further sanctions as far as the revenues from oil and gas sales to Europe are concerned. So an oil embargo, a gas embargo would really help in the sense of bringing Russia's war effort to an end. Because Russia's war effort is financed through these sales of gas and oil at this stage. So that's one thing.
Why is Ukraine, okay, Alexander, why is Ukraine allowing Russian gas to transit its territory? If that is the case, if Europe should cut off Russia in terms of an energy supplier, why is Ukraine still facilitating the transit of that gas?
Well, remember, we were also receiving fees over the years for the transit of gas through our territory. So this wasn't happening for free. Now, of course, the reliance of our budget on these revenues, on this stream of income, is negligible at this stage. And of course, what we care about most is bringing Russia's war effort, Russia's war machine to a halt. And that can be done by putting them into a serial fiscal problem. And that will be done through an oil and gas embargo in Europe.
Well, let me pick up on that topic. If you're talking about transit fees that you're actually getting, how much are you actually getting, and how much are you still waiting for in terms of offsetting perhaps some of the losses of the war?
Well, I mean, you can look up the numbers, but it's at this point, it's insufficient as far as, our actual expenditure needs are concerned. So, what matters here is bringing Russia's war machine to an end. We have a serious fiscal concern too, because our economy is collapsing. We can't really put numbers on this at this stage, but we know that we've given up percentages in terms of GDP growth. So we're really facing a disaster in terms of what's happening to our economy.
Absolutely. We'll come to that in just a moment. It was interesting to hear the Germans today talking about a Marshall Plan. Before we get to that, can I just return to the issue of the talks? There is an ongoing and serious concern, and this is being vocalized by the US president and others, that Russia is prepared to use chemical weapons. If chemical weapons are used, are talks still possible?
Well, I hope this is really a red line if that happens. We've seen, episodes in the past where the red lines have been drawn in the conflict in Syria, for example, and then not implemented. So we're obviously wondering in Ukraine what else needs to happen for the world to take this more seriously. If there is use of weapons of mass destruction, of which chemical weapons are one type, then we really hope that nobody will just sit back and watch what happens. Of course, we hope there'll be an intervention. We know that chemical weapons could be used at this stage because Russia is facing serious issues taking our cities. They can't really take our cities without serious losses to their troops or without destroying our cities. And so from a brutal militaristic perspective, the use of chemical weapons could be a solution, inverted commas, to them. But we hope this won't happen, of course.
Well, in terms of the talks, at the start of this interview, you mentioned that the territorial conversations were a hard no from the Ukrainian delegation. But I'm curious about the specific regions of Donetsk and Luhansk in particular. Are those, just given the separatist movement there, is there any wiggle room when it comes to those territories in particular?
Well, as far as we are concerned, we're not going to compromise on our sovereignty. We're not going to compromise on our territories. So there is no wiggle room, as you say. There is perhaps wiggle room to our neutrality status, although, again, we're just saying we're putting off the NATO accession talks for now. NATO has basically said no to us. We're also in the middle of a war. So as long as we're giving security guarantees, we can talk about that. But there's no wiggle room as far as our territory is concerned. And if you ask the people who live there, they're not willing to take any wiggle room. They're not willing to discuss this either.
In terms of the rebuilding of Ukraine, were we to get to a point where it would be possible, the Germans are talking about a Marshall Plan. What would that Marshall Plan need to include? What do you think it would need to look like? Put your economist hat on for a moment.
Well, of course, look, our infrastructure is destroyed. So this would have to be billions and billions, right? We need a really big program for Ukraine that would primarily, in the early stages, be focused on rebuilding our infrastructure. Our bridges, our roads have been completely destroyed in large parts of the country. Actually, they've been just built up recently because President Zelensky had a program that was really focused on infrastructure.
Alexander, do you think joining the EU would be a necessary prerequisite at that point?
Well, joining the EU would, of course, help us because, again, we would be getting funds from the EU. We'll be integrating with the EU. We'll be part of the common market in the EU. Of course, that will help us. But at the same time, we understand that this is not something that happens overnight. We also have to build up our institutions in many respects, our economic institutions, which are still lagging. So we know that. We have to do our homework, and we've been doing our homework in many respects. So joining the EU would definitely help, but it doesn't happen overnight.
Alexander, really appreciate your time today. Thank you very much indeed for joining us. Alexander Rodniansky, advisor to President Zelensky. Thank you very much indeed. This is Bloomberg.